Imagine making the amount of money you've dreamed of earning only to have to pay a big chunk of it in taxes. Imagine making the amount of money you've dreamed of earning only to have to pay a big chunk of it in taxes. Consider the top 7 tax reduction strategies for high-income earners that can help you keep that money you've worked so hard for. Then, you will be able to enjoy the life you want without having to pay more in taxes than necessary. Soon enough, filing taxes will be a breeze. 1. Start or invest in a business. One of the best tax reduction strategies is to invest money into a business. If you don't have a business already, you should start one so that you can invest money into a company. When you have a business, you'll have plenty of business expenses, such as office equipment. Be sure to talk to an accountant or another professional to verify that something qualifies as a business expense. Then, you won't have to worry about dealing with an audit and having to pay more in taxes. To make sure you can reduce your taxes as much as possible, track your expenses throughout the year. When you go to file your taxes, you can go over those expenses with your accountant. Make the most of it. If you want to make the most of starting a business, hire your family. When you hire your spouse, you can contribute to a retirement account and deduct that from your joint tax return. You can also hire your kids to get similar benefits. If you contribute to retirement accounts, for example, you can deduct the amount that your business contributes. Investing in the family members who work for your business can be an easy option for how to pay less taxes. 2. Max out your retirement account. Another one of the best tax reduction strategies for high-income earners is to contribute to a retirement account. Specifically, contribute to a traditional 401k or IRA. These retirement accounts use pre-tax money, so you can deduct your contributions from your taxable income. A traditional IRA is a good option when you work for yourself and don't have another account. However, if you have access to a 401k, you can contribute to that as well. The maximum contribution for a 401k is $19,500 in 2021 and goes up over time. On the other hand, you can only contribute up to $6,000 to an IRA during the same year. If you don't have access to a 401k through an employer, consider setting one up for yourself. Then, you'll be able to contribute even more money to retirement. And you'll be able to reduce your taxable income. Make the most of it. While you can set up a Roth IRA, the contributions to that account will be post-tax. This is a better strategy for people with lower incomes, and it won't do anything for your tax burden. As your income increases, you should switch your focus to a traditional IRA to get the tax savings now. You can still keep your Roth IRA open, and it can continue to earn interest tax-free. 3. Choose an HSA-eligible health plan. When shopping for health insurance, you have to consider a lot of factors. You need to make sure the plan covers your doctors and any prescriptions that you or your family members take. However, before choosing the first plan you find, look for an HSA-eligible plan. A health savings account, HSA, is where you can save money specifically for health expenses, and your contributions are tax-free. Make the most of it. If you're self-employed, you can look for an HSA plan with a somewhat higher premium. While these plans usually have affordable premiums, you can deduct the cost of the premium from your income when you work for yourself. Whether you work for yourself or someone else, you should max out the contributions to your HSA. Even if you don't think you'll use the money, it's nice to have in savings. Plus, you will be able to use those contributions to lower your taxable income. 4. Maximize tax credits. You can look at other tax credits that you may qualify for to reduce your taxable income. Depending on how high your income is, you may be able to get certain tax credits. For example, you may qualify for the American Opportunity Credit if your child is in college. You can get up to $2,500 per student when they attend college. Another tax credit you can get is the plug-in electric drive motor vehicle credit. If you buy a new electric vehicle, you can get up to $7,500 depending on the number of wheels. Make the most of it. You should look for tax credits that either have a high income cap or no cap at all. Then, you can qualify for different credits for investing in education or new energy. If you're close to an income cap, you can increase your savings or investments to reduce your income. That way, you may be able to qualify for a credit. 5. Increase charitable donations. Another excellent option for how to pay less taxes is to donate to charity. Whether you donate a car or cash, you can give to a 501(c)(3) organization or multiple organizations. If you do give money, be sure to keep track of how much you give. When you file your taxes, you can report those donations to help lower your tax burden. Donating to charity is a good thing for anyone to do. But if you've tried other options and still want to lower your income, find new organizations that need your help. Then, you may be able to lower your income significantly, so that you don't have to pay as much in taxes. Make the most of it. At the end of the year, review your income and get an estimate of your tax bill. Then, you can figure out how much to donate to charity before the year ends. Make those donations to help lower your tax bill for that year.